Welcome to Alpha Found. The goal of the following videos is to introduce and defend a new model for stock market dynamics. The primary way of demonstrating the correctness of the model will be to explain why low volatility portfolios tend to generate positive alphas. It is the intent of these videos to transform the high alphas of low beta portfolios from a statistical anomaly into a mathematical expectation. It will take a while to get there, and we will move slowly. If you are watching this, then you likely know that alpha has been the object of affection for active investors for decades. My favorite book on the subject is Finding Alpha by Eric Falkenstein. But there are many other books to consider, such as Searching for Alpha. And then there is The Quest for Alpha. Notice the subtitle, The Holy Grail of Investing. There are many other titles to consider, such as Active Alpha, The Alpha Formula, The Alpha Hunter, The Alpha Masters, The Alpha Strategy, Alpha Trader, Alpha Trading, Better Than Alpha, Delivering Alpha, Finding Alphas, Geopolitical Alpha, Hedge Fund Alpha, The Incredible Shrinking Alpha, 2nd edition, Organizational Alpha, Quantitative Strategies for Achieving Alpha, What's It All About Alpha? Likely there are some titles that were missed. There are investor websites such as Seeking Alpha and countless databases, consultants, and investment analytics companies measuring, reporting, and contemplating alpha. All of this intellectual and computational output is for one reason. Alpha is excess return after adjusting for systematic risk. That's what everyone wants, excess risk-adjusted return. Positive alpha is the reward for having more luck, being smarter, or being faster than the other investors. Historically, alpha has been strongly associated with low-risk stocks, but according to theory, it shouldn't happen that way. Any stock or portfolio of stocks should be just as likely as any other to have positive alpha, but that's not how it happens. A great deal of work has gone into understanding why it doesn't happen that way, but it remains a mystery. Or at least many people find that the proposed explanations, however insightful, are ultimately unsatisfying. More on that in later videos. The mystery of why low-risk stocks tend to generate high alphas has a name. It's called the volatility effect or the low volatility anomaly. I'm going to call it the volatility effect because it's easier. In addition to explaining the volatility effect, the proposed new model brings several other concepts into a new analytical framework. Concepts such as excess volatility, bloom betas, and zero beta portfolios, which are known more to finance academics than to investment professionals, will be seen in a new and hopefully brighter light. Most of those looking for alpha do so by looking for better insights into financial analysis, accounting data, or economic forecasts. The new model is a mathematical and statistical model that was developed without reference to things such as ratio analysis, growth rates, free cash flow, the dividend discount model, or really any valuation model, fiscal and monetary policy, corporate governance, or technical analysis. Not that there is anything wrong with those things. In fact, there may be a lot right with them. They're just not a part of this model. Before we get to the new model, there are a few things we'll need to cover. The background in literature, a definition of terms, including a careful definition of the volatility effect, alternate models, and finally, the assumptions of the capital asset pricing model and the consequences of relaxing those assumptions. After that, once the new model is introduced, with a few exceptions, the vocabulary and mathematics will be in terms of elementary statistics. In order to understand everything, you will need a fluency in elementary algebra, a fluency in elementary statistics, including ordinary least squares regression, and a working knowledge of capital market theory. For those possessing the prerequisites in abundance, it will be the 9th video before anything new or interesting appears on the screen. The videos start out at an introductory and review level, although some more difficult ideas are referenced. In later videos, there'll be plenty to chew on. In the first several videos, there are extensive references to the academic and popular literature. This is to give credit where credit is due, but also for those who want to chase down the sources, it will be easier knowing what the sources are. See the website associated with these videos for a complete bibliography. Finally, if you find an error, I would be grateful if you'd let me know at the email shown on the screen or found in the information below the video.